So the four things that I wanted to go over this week is the time value of money, because it's an economic concept about, the money today isn't worth the same tomorrow, but I want to make sure you understand how that applies in the context of a healthcare finance setting. I want to talk about payback, which is a time break-even. The reason why I'm calling attention to this is because we discussed the whole concept of volume and price or cost break-even last week, so this is somewhat of a different take on it. It's more from a time standpoint. Definitely want to go over the debt versus equity financing, the whole discussion around capital structure. Once you listen and participate in tonight's Excel PowerPoint file, I hope that you will see that the capital structure concept is actually really simple. It's just a matter of setting up your formulas correctly and setting up your spreadsheet to be able to walk you through the kind of the ideas of how you need to calculate the taxable income versus what the net profit's going to be, and then how that all plays into return on equity. So we'll spend a significant portion of this evening talking about that. But then I also want to make sure that you've had a chance to read over the course resources, specifically the capital justification, because that is something that an entry-level financial department leader will have to do. And a lot of this capital structure stuff may seem like something, oh, well, only the accounting or only the finance professionals do it. But your understanding of capital justification is going to go hand in hand with this understanding of capital structure. So I want to show you how the two are connected and also make sure that you understand kind of the thought process and the steps that you would need to take in order to do the capital justifications. And then if we have time, we'll do a little bit of a week 3 review. So I am now on slide number 4. This is, again, just one of those formulas that you have to know. Memorize it, make sure you know how to access it, make sure you put it on your key formulas sheet. When we're talking about time value of money, it's this concept that $1 today isn't equal to $1 tomorrow. Now, the tomorrow and the today are in quotation marks on the slide in the bottom left-hand corner in that blue little box. The reason why it's in quotes is because we're not literally talking about, October the 11th and October the 12th as today and tomorrow, although in some cases you could. We're just talking about, passage of time, whether that's 1 day, 1 month, 1 week, 1 year, 10 years. It's just today versus tomorrow, quotation marks. So the best way that I can explain this is if you think about asking your grandparents or your parents how much they spent when they bought their first house. A lot of you are going to hear responses like, oh, it cost me $20,000 to buy my first house. And we sit here today in 2016 and we're kind of shocked by that $20,000 figure. But that right there illustrates the concept, the time value of money. The dollar amount of $20,000 does not equal, in today's terms, 2016, what it equaled in 1960, 1970, or whatever the case may be. So it's this idea that through inflation and sometimes deflation, the cost of goods and services either increases in the case of inflation or decreases in the case of deflation. So when you talk about, even for a lot of us are adults with life experience. If you think back 10, 15 years ago, I remember when I bought a used car, I could buy a used car for about, $2,000 and it wasn't going to be a junker. And nowadays you spend $2,000, it's almost like you're almost guaranteed to get a lemon because it's going to be high mileage or whatever the case may be. You just can't buy the same amount of goods and services with the same amount of money. So that's all that time value of money is talking about. And then we have these fancy formulas. So if you want to take into consideration this idea that today's dollar doesn't equal a dollar tomorrow, you use either the compounding version of the formula for future value, or you use the present value formula, which discounts the future value of cash. So in the first example of compounding, it's like me saying, well, what is the value of $1,000 that I'm going to put into the bank today at whatever interest rate? Right now we're barely getting 1%, right, on many of our deposits. So what's the value of $1,000 at 1% 10 years from now? So you get that value. And then opposite is true for discounting. So if I am going to get $20,000 5 years from now, what is that $20,000 worth in today's terms? And that's, if you think about from a lottery standpoint, the present value is really applicable. They'll tell you that, you know, you're winning a lottery for $1 million. Well, that's $1 million in the long term. So what's the present value of that $1 million today? It might only be like $300,000, $400,000, depending on what the interest rate is that they're calculating into that formula. So again, time value of money, fairly simple, just follow the formulas. It's looking at how the value of money changes, what you can buy, the worth of a dollar. Sure, the dollar bill is still going to be a dollar bill, but that's just the face value. That's what's written on the actual paper piece of money. But a dollar doesn't go as far as it did 20 years ago, 5 years ago even, 10 years ago. Because the time value of money impacts the worth of that dollar. Just a few clarifications. When you see N in these formulas, there's a superscript N and a subscript N. There are two different meanings. The superscript, which is the one that goes above, that is a mathematical operation to indicate that you're taking something to a certain power, versus a subscript N, which is on the bottom. It's going to represent at a certain period in time, like future value of 5 years from now, or the present value, the future value of 10 years from now. So it's a label only, so it doesn't have any kind of mathematical significance. Okay, I'm going to move on to slide number 5. Payback period, which is the time break-even analysis. Again, I'm not going to spend too much time on this because the math is fairly straightforward. If you can add, you can calculate. If you can add and divide, you can calculate payback. So in the first 3 columns there, you can see the information. In this problem, you have 5 years, or rather 6 years of data with annual cash flows. So you might be asked in a question, well, what is the cumulative cash flow? And you might be asked the question, well, what is the payback period? So the cumulative cash flow you can see in the blue column, which is the calculations. All it is the previous year plus whatever cash flows in the current year. So you can see in year 1, the cash flows were negative 500 from the previous year 0, and then you had a positive $100. So you add the negative 500 and the 100, the positive 100, and you have now a negative 400. That's the cumulative effect. So it's just whatever the ending kind of balance was in the previous year plus whatever cash flows were incurred in that current year is going to be your cumulative cash flow figure. When you're trying to calculate the payback, again, you're looking at the 2 years between which the cash flow, the cumulative cash flow, goes from negative to positive. So you can see here the switch from a negative cumulative cash flow was on negative 125 in year 3, and then it changes to a positive 125 in year 4. So you know payback is going to occur sometime between year 3 and year 4. Well, if we assume that the cash flow of $150, of the cash flow of the $250 in year 4 is evenly distributed throughout year 4. So 250 divided by 12 throughout the year. Then all you have to do is take that negative 125 figure and divide it by the 250 to get a decimal point, and you know that that's a half. So you know that at halfway between during year 4, you're going to achieve that payback so that you have a cumulative cash flow of 0. That's essentially what the 125 divided by 250 does for you, is it gets you to that point where you have no negative cash flows, no positive cash flows, you're just at 0. So again, determine where it goes from negative to positive. It's between year 3 and 4. To determine the decimal, the 0.5, you're going to take the negative 125 divided by the 250. The negative and the positive really don't have significance in this case, but I just wanted to indicate which numbers I was dividing with each other. So the negative 125 in year 3 divided by the positive 250 in year 4 is going to give you that 0.5, meaning that halfway through the year of year 4, you're going to achieve a cumulative cash flow of 0. And you're going to cover that negative, and it's going to be positive from that after that point. So the 0.5 represents 6 months, right? Because we have 12 months in a year. 3.5 years would be 3 years and 6 months. So I hope that makes sense. Okay. And I have a little note there in the bottom left-hand corner. The net present value is the sum of the present value of all future cash flows. In case you're wondering what how all of these terms relate to one another. So the net present value, if you go back to the previous slide, you know what present value is. All we're doing is adding the word net to it. Net meaning there are multiple years of different cash flows. So you need to calculate the present value of each of the 100, the 125, the 150, the 250, the 325. So each of the cash flows in each of the years given, you calculate the present value of those and then you add them together. And that is your net present value. And that's all that is. All right. Let's move to slide number 6. Now, slides 6 and 7 afterwards or somewhere in between, I'm going to pull up an Excel spreadsheet to also illustrate how we're going to apply this whole capital structure theory to debt and equity financing. But before I move on, Elisabeth has a question. Can you put in months or answer? Elisabeth, I'm going to assume that your question is, can you put in 3.5 years, or do you have to put in 3 years and 6 months? Hopefully that's your question. You would just put in 3.5. It's just, okay. Yeah, you just put in 3.5. I know what you mean by 3 years and 6 months. It's going to be abbreviated 3.5. I hope that answers your question. Okay, so going back to slide number 6. So I wanted to take some time to go over Exhibit 8.2, which is on page 236 of your textbook. So if you want to, you can get your textbook out and turn there. I think, as I've mentioned before, I think Kopinski does a really excellent job in his textbooks going through a lot of his examples, both in text format as well as a lot of the supplementary exhibits that he has. This is one where I think if he had added a little bit more information in his actual Exhibit 8.2, it would have been a lot easier to follow. So I'm going to attempt to do that on his behalf during this lecture. So again, we're talking about this super health clinic who is trying to decide between debt financing and equity financing and trying to figure out an appropriate capital structure theory. So we're going to walk through this kind of case example from the book in Excel so that you can see exactly how to set this up. But before we do that, I want to make sure that we understand the difference between debt and equity financing. So debt financing is really borrowing money. So I hope you're understanding that we're borrowing money either through doing bonds, either through going to the bank and actually just getting a loan or whatever the case may be, but you're borrowing money. Borrowing money usually means that when you pay the bank back, you have to pay not only the borrowed amount, which is the principal, but you also have to pay the interest. And interest is really the cost of money, right? So if I wanted to go out and buy a brand new car for, I don't know, $40,000, and I don't have $40,000 and I go get a loan from the bank to borrow $40,000, the bank isn't just going to say, here you go, here's $40,000. They're going to charge me interest. That's how banks make money, right? They make money because they have money that people want to borrow because people don't have the money on hand. But in order to borrow that money, they have to charge you money for the privilege of borrowing money. So interest rates is really the cost of borrowing money. So when you're talking about, in the case of a healthcare organization, they could be borrowing money for a variety of reasons. They could be wanting to expand physical space. They might want to purchase a new practice. They might want to buy, the latest and greatest technology, CT scanners, MR machines, PET scanners, whatever the case may be. So there's a whole number of reasons why they could be borrowing money for capital expenditures. There could be lots of capital expenses that a healthcare organization would want to purchase. This is in contrast to equity financing. Equity financing means that you have the money and you're going to put forth your own money to fund whatever capital purchase. So in the case of my car example, if I have my $40,000 in the bank and I want to purchase that car without borrowing money, I could be 100% equity financed and just pay for it out of pocket, essentially, is what it would be like. In the case of a healthcare setting, the equity financing comes in from all of the profits that you have made in the previous years that have been retained within the organizations. So that could be called the residual earnings, which are essentially your profits. It could be how else do they call it? There's another term for it. It's escaping me at the moment. But it's all of the profits, the proceeds that you have made from operating your business. So that profit line, which becomes really important when you are trying to do expansions or buy equipment or buy practices and things like that. You need to make a margin. You need to have your bottom line be in the black, not in the red, so that this option is available to you, that equity financing option. Most times, though, you will find that organizations, healthcare organizations especially, do not want to tap into 100% equity financing because it's a little bit riskier. And you can see that in the last bullet point on the equity financing slide. If you have all equity financing, you have the possibility of running out of money. And if you run out of money, it becomes a solvency issue and you could go into bankruptcy. So there's a reason why even if you have the money, you may not want to tap into all of that. So it's kind of like, for myself, at least personally, when we purchased our second home, we had all of our proceeds from selling our first home, and we could have probably borrowed less money from the bank to purchase our second home, but we purposefully borrowed more money for that financial leverage, and you can see that on the left-hand side of this current slide. We're trying to leverage borrowing money so that we can retain some of our equity for other types of emergencies. And so it's a financial strategy. And again, at a middle manager level, you probably wouldn't be engaging in some of the strategy around debt versus equity financing, but I will explain towards the end, why these concepts are important for you to understand, at least high level, what's going on. So let's see here. Any questions on this slide? I think I'm going to move on because a lot of this is already in the book. I just wanted to emphasize debt is borrowing and equity is you have money from within. Okay, so then in the next slide, slide number 7, we're talking about capital structure. And capital structure is just a fancy way of saying, well, what is your mix of debt and equity? So what percentage are you incurring the debt and what percentage are you financing capital expenses through equity financing? That's all it is. So it's kind of like patient mix. What percent do you have Medicare? What percent do you have your MA? What percent do you have commercial? It's a mix. So capital structure is really just this mix of debt and equity. So when you're talking about debt financing, some of the pros and cons comparing debt and equity financing. So because you are borrowing money, you have to understand that you're going to have interest payments. So that's an additional expense that you're going to incur because you're borrowing money, and again, a bank isn't just going to give you money for free, so you have that interest rate. So you're going to have interest expense. However, from a positive standpoint, interest expenses they reduce your tax liability. Just like if you own a home, your interest payments on your mortgage are also going to reduce your tax liability. They decrease what you are taxed upon. On the flip side, when you look at equity financing, a con is that owners have to invest their own money. Now, owners, I should have put that in quotations as well. When you have a not-for-profit, the owner really is the community, right? Because all of the proceeds that the organization is making, all of the profits, are really community-owned, so to speak. There is no owner at the end of the day taking home a bonus payment because they're making, huge margins. The salaries are for the management personnel, the salaries are for the staff that are working it, from your CSR to your practice manager to your nurse to your rad tech, etc. So Owners is used fairly loosely from a nonprofit standpoint. However, there are lots of for-profit healthcare organizations. They could be for-profit ambulatory surgery centers. They could be for-profit diagnostic laboratories. They could be for-profit nursing homes, CCRCs. So there are owners in healthcare, but typically most people are accustomed to understanding healthcare organizations as nonprofit. So I just wanted to make sure that the word owners doesn't throw you off there. So that's a con, is that, somebody has to invest their own money into the capital expenses. However, on the flip side, the positive is that if you do have equity financing, you don't have interest payments. So you don't have any borrowed money interest expense. Now, again, this is kind of a double-edged sword. Even though you don't have interest payments, which is a good thing, you also have higher taxable income because you can't deduct it. So whereas on the left-hand side with debt financing, you would actually reduce your liability on taxable income because you can deduct the interest expense. On equity financing, you cannot because there are no interest expenses, so there would be nothing to deduct to reduce your tax liability. All right, so that was a lot. It seems like a small slide, but there's actually a lot going on there. Do you have any questions? So diving into the SuperHealth example, Exhibit 8.2, a little bit, and maybe it'll start clicking once we go through this example. So page 235 to the top of page 236 outlines, what you're trying to do. So in a nutshell, SuperHealth is a for-profit organization, and they need $200,000 to start up. So that could be for equipment, for inventory, for supplies, whatever. They need $200,000 of assets to begin their organization. And the question would be, let's say, suppose you do have $200,000 in the bank. Would you choose to invest all of that $200,000, so 100% equity financing, no debt, or should you borrow money? And the case study example in the Kapinski textbook talks about a 50% debt financing. So the capital structure would look like 50% debt, 50% equity. That 50% is completely arbitrary. So you can have that at whatever you want, whatever you think from a capital structure decision-making standpoint would make sense. So again, arbitrary. So if you look at the two, what we're trying to compare is out of the $200,000 on the left, if you do debt financing, you would take a loan for $100,000, right? So because 50%, if you do debt financing, would be 50% of $200,000, so it's half. So half of $200,000 is $100,000. Or on the right-hand side, if you do equity financing, that means you would finance the full $200,000, all equity, no debt. So that's bullet point number 1. Now, if you look at bullet point number 2, on the debt financing, the case study example tells you you're going to pay 10% interest on that $100,000 because you're borrowing $100,000. Let's call it the bank. The bank's going to charge you 10%, and so 10% of $100,000 is going to be $10,000 in interest expense. Again, if you look in the parentheses there, it increases your interest expense cost, but it also reduces your taxable income. Remember, it can be written off, just like your mortgage interest expenses. It reduces your tax liability. So if your taxable income decreases, then the amount that you're going to pay in taxes is also going to decrease. Okay, so hopefully you understand the logic there. On the right-hand side, if you're looking at equity financing, you can say, 10% interest on zero is nothing because there is no interest expense. You didn't borrow money, so there's nothing to calculate in terms of an interest expense. So that's a good thing, but again, it results in that higher taxable income because you can't write it off. You can't deduct it, and so you're going to end up paying higher amounts in taxes compared to your debt financing counterpart on the left-hand side because, again, of that interest expense being able to be written off. Now, in all of this, you have to remember the balance sheet equation, and you also have to remember the P&L statement equation. So the balance sheet equation is up there for you because it's been a while since we've covered it. I think it was week 2, the last time we covered it. So assets equals liabilities plus owner's equity. You have to know that. The other thing that you might want to know is EBITDA. EBITDA, lower left. EBITDA, it stands for earnings before interest, tax, and amortization. So it's essentially your taxable income. And I believe the reason why I put that in there is because on page 236, Gopinski refers to it as taxable income, but there are, I believe, end of chapter problems to which he refers to this as EBITDA. So just wanted to make sure that you understood the terms there. I'm not sure why in financing we just have all of these terms to refer to the same thing. It gets a little confusing. But all right, so here, this is the setup. So I'm going to move into Excel now. So whenever you have a problem like this, when you're talking about capital structure, you're looking at debt versus equity financing, the best thing you can do is just set up a spreadsheet. And the first thing that you want to do when you spread up this spreadsheet is you want to record your assumptions. So if you look at the area that I have highlighted on my computer screen now, hopefully you can see it. If you can't, please type into the little chat box that you cannot see it. I'm going to assume that you can. So the assumptions here, remember, the assets that are required, $200,000. What's the interest rate on the debt? 10%. What is the projected operating revenues? 150, operating costs, 100,000, and then the tax rate for a for-profit business, we're going to assume 40%. All of these 5 details were given in the textbook. Okay, so this is no new information. I have my equation there, assets equals liabilities plus owner's equity. And then I have my question in numerical terms set up there. So my option number 1 is 0 debt, 100% equity financing. My option 2 is 50% debt, 50% equity financing. So again, everything over here in columns A through B, no new information. This is all just what was given to you in the case study example. So that makes sense, correct? I think it's just now refreshing that I have everything in columns A and B highlighted. Okay, so let's move on. The first thing that you should do, and this is where I think Gopinski would have been better to have done it this way in his textbook example, is set up the balance sheet for both option number 1 and option number 2. So you can see here in gray I have highlighted option number 1, again, is that all equity financing, 0% debt. Option number 2 is your 50-50, 50% equity, 50% debt. And again, all you're doing is setting up your balance sheet so that you have assets right here equals liabilities plus owner's equity. That's what these, the single bar above the cell and a double bar underneath the cell, that represents kind of a subtotal. So you want this number and this number, the 2 cells that I have currently highlighted on your screen, you want those 2 cells to be equal. Well, how do you get that to be equal? Well, let's just think through this. Your assets, we were told what the assets were, right? So we can just do equals and go over here under our assumptions and click in cell B5. The best thing that you can do in Excel is to use cell references when you're writing formulas. Never type out the actual value because you're prone to error that way, especially when you're updating things or changing things around or running some scenarios. You can change cell B5 to reflect whatever assets you need it to reflect, and all of the formulas that contain cell reference B5 will be automatically updated versus having to go through and manually adjusting everything. So again, assets are $200,000. It's going to be the same in both scenarios. Assets are $200, so you can fill out both option number 1 and option number 2. Now, liabilities and equity. This is where you need to understand the 2 options that you have. So in the first option, it was no debt. So from a liability standpoint, it's pretty simple. You can just say 0, correct? For equity, again, also pretty simple because you're saying it's 100% all equity financing. So I'm just going to say it's going to equal my assets at $200,000. So now your total liabilities and owner's equity, that's pretty simple. I'm just going to do it the long way so you can see. It's your equals sum of your liabilities and your equity, which is what the label in cell D10 is saying, total liabilities and equity. So that's $200,000. This and this match. right? So we're good from an accounting equation standpoint for your balance sheet. Now let's come over here and do the same thing for the option number 2, which is a 50-50 capital structure, 50% debt, 50% equity financing. So if we do that, that means our liabilities are going to be 50%, which is why I have this down here in the lower left, 50% of the assets that are required, so multiplied by the assets, so you can see my formula there. So $100,000, that makes a lot of sense. That's what the book is saying. From an equity, same thing. It's a 50% times the required assets, another $100,000. Conceptually, does this make sense? Is $100,000 50% of 200? Yes. Is $100,000 for equity 50% of 200? Yes. So now again, we're going to do the accounting equation. We're going to sum it. And we have this value equaling this value. We're in check, so we're good from a balance sheet equation. So right now, we're still just kind of setting up the problem. And that's probably why Gopinski didn't include this top portion when he was doing his exhibit, but you'll see later why it's important to have that there. So from an operating P&L statement standpoint, let's figure in what we know. So we know that operating revenues is $150,000. That was already given to us. Same thing over here. It's given to us. Operating costs given to us. So you can see a lot of this is already kind of given to us. Now, what's the operating income? If your revenues and your costs are 150 and 100, your operating income is just going to be your revenue minus your costs, correct? So that's $50,000. Again, that's really nothing new. That's something you've seen in last week, probably even the week before. So all three of those are not new information. This is all coming from the case example. Now, this is where it gets interesting. When you have an interest expense here, are you going to have any interest expense if you have zero liabilities? No, because it's that from that previous slide, 10% of $0 is going to be 0. So you have no interest expense, but just so you can see the equation, $0 times the 10% is going to be 0. However, in option number 2, we do have some borrowed money. So how much did we borrow? We borrowed $100,000. What was the interest rate? 10%. All right, so you can see my formula there in cell H17. It would be my $100,000 of debt times my interest rate for debt. Okay, so that's $10,000. And we already calculated that in the previous slide, so we know what we're talking about here is making sense. Now, what's my taxable income? Remember, I talked about when you do all equity financing, one of the disadvantages is that since you don't have interest income or interest expense, which on the surface is a good thing, the effect of that, though, is if you can't deduct your interest expenses, you're going to have a higher taxable income. So your taxable income here is going to be your $50,000 minus, in this case, sorry, 0 because we didn't borrow any money. So $50,000. In this case, look, since we have interest income, now we have our $50,000 minus our $10,000 interest expense. So immediately our taxable income, you can notice a difference. $40,000 in the case of 50-50 debt and equity versus the $50,000 if we do all equity financing. Okay? Now, this is where the taxes come into play. The tax rate is 40% up here. Well, our taxable income in scenario 1 is $50,000. So we're going to take that times our tax rate of 40%. So our taxes are going to be $20,000. If I just copy $1,000 times our tax rate. So our tax liability, sorry, my screen's jumping around on you. Tax liability is $16,000 in the case of the 50-50 capital structure. All right, so net income, again, is pretty easy to calculate. It's your taxable income minus your taxes. Again, do the same thing on the left. So now you can right away see a difference in your net income. So your net income, when you do all equity, yep, it's $30,000. But in the case of your half equity, half debt scenario, it's now $24,000. And it all stems from this interest expense line. Because again, in this case, we didn't have any borrowed money, therefore no interest expense. Therefore, our taxable income was higher compared to if we did borrow money. And it's a trickle-down effect from there. So then from there, your return on equity, if you look at the equation, which I have on the screen, is simply your net income divided by your equity. So in this case, you have your $30,000 divided by the full $200,000 that you put forth of your own money to finance this project, and so that's a 15% return on equity versus on the right-hand side when you have borrowed money for 50%, you have a net income of $24,000 and your equity is $100,000 in this case, so you have a higher return on equity. And remember, return on equity is basically how hard your money is working for you. So in the case of option number 2, where you're only putting forth $100,000, that $100,000 is working pretty hard for you at a rate of 24%. Okay, so I'm going to stop there for a second and let you catch up and see if you have any questions. I hope you were able to see all of the motions on the screen. Do you have any questions? Hoping that once you saw the example being worked through from balance sheet all the way through the P&L statement, and you can see the relationships between, whether the debt or the equity influences the taxable income and therefore the taxes, and ultimately the net income line, which eventually will have an effect on ROE. I hope all of those calculations seem rather simple now. It's just a matter of walking through the example. Okay, you don't understand exactly what ROE means. So it's a measure of, like I said, how well the owner's money is working for them. So in the case of, on the left-hand side, when you have all equity, so the owners are putting in $200,000, and the ROE is at 15%, meaning that the profit that is being generated by the $200,000 investment is basically 15 cents on the dollar. Whereas over on option number 2, the rate is much higher. So out of the $100,000, they're generating essentially 24 cents on the dollar. So it's how much your equity dollars are working to generate that net profit amount. The higher the number, the better, to a certain point. And that the balance between the return on equity is really where financial leverage comes in. So I believe financial leverage, it's on one of these pages surrounding this exhibit, but it's looking at how can you leverage debt. So we can see how equity financing from an ROE standpoint, how that's going to play into the returns being how much net income you're generating for an organization. Financial leverage is kind of looking at it from the debt perspective. How can you leverage debt? How can you look at borrowing money as a way to favorably influence your bottom line? I hope that helps, Steph. A lot of these concepts, they're pretty deep concepts that if you don't work in finance, it might be very difficult to understand. So, don't be too hard on yourself if it doesn't make if it doesn't make sense right away. Some of these things you have to kind of wrestle with, let them soak in a little bit. But it is a matter of looking at how much money is working for you. How successful the investments were or the techniques that you use to invest money. Okay, sorry, there's another question. The higher the percentage, the better. So absolutely. So in this case, right, you would want to, the decision would be if you had a choice between 100% of equity financing versus 50% equity financing, you would go with the 50%. Because from an owner's standpoint, you're actually able to leverage debt better and your ROE is higher in comparing the two scenarios. You're getting a 15% return when you're looking at all equity versus a 24%. So it's a 9% difference between the two. Hope that answers your question. What about the fact that net income is less? Absolutely. So you can look at that. And that's an argument for why somebody might say, well, but at the end of the day, you're actually making more money if you're doing equity financing. Absolutely. And so there is no, some organizations that are very much owner-owned, meaning that there are people involved, are going to be looking at your ROE numbers, because when they see ROE, that means that's money going into their pocketbooks, versus from a healthcare organization that's more nonprofit, not really looking to, there aren't people looking to put money in their actual wallets. They might say, well, at the end of the day, what we want is more net income, because more net income means that we have more to reinvest into the organization. So an argument could be made for either. So thank you, Jen, for catching that. I wanted to make that statement, and I forgot to. So yes, it's not necessarily all black and white. There's a lot of different positions that finance professionals and management professionals can make when you're talking about these types of decisions. But if the question, so let me clarify, in this class, if the question is, which has an ROE that's higher, when you're looking at two options, go with the ROE calculation. So 24%, option 2 would be the answer. I don't understand how the owner is getting an ROE when they are borrowing the money. Well, they're only borrowing half, so the ROE is just looking at the $100,000 that they invested. So out of the $100,000 that they invested, how hard is that $100,000 working in order to generate their net income of $24,000? And they're looking at that and saying, okay, well, that's 24% compared to if I had to finance 100% of it, $200,000, then I'm only getting a return of 15%. So yeah, they still have to borrow money, and you can see it's reflected in terms of there's a cost to them, right? So they have to incur an interest expense of that $10,000. So it's not free. They actually had to pay to borrow the money, but in doing so, they now have $100,000 still in their bank account to work with. So if the $200,000 that they had originally, if that was all they had to their name, if they invested all of that into the business, what happens if the business went belly up? Then they would lose $200,000. In this case, they're only risking $100,000. The other $100,000 is technically being risked by the bank. And so it's also freeing up the $100,000 for the owner, the quote-unquote owner, to do other investments or to purchase other capital equipment, etc. So again, these are not necessarily clear-cut answers, and finance professionals will disagree, have different positions. But like I said, for my personal scenario, my husband and I had more money in the bank that we could have put forth into our new home, but we decided against it because we wanted that extra equity to work with in the case of, let's say, one of us lost a job or something like that. We preferred to use that financial leverage through debt to say, okay, well, we're willing to borrow the extra money because in the end it's going to have a more favorable outcome. You might just need to let some of these concepts soak in. Like I said, a lot of these week 4 finance concepts are a little bit deeper than a middle manager would have to really go through on a daily basis. So it's not like your simple P&L statement, although there are components of it that you have to understand in order to calculate ROE and things like that. But just this overarching concept, stay high on this, understand kind of how things work, kind of the high level slides, 6 and 7 and 8 to understand why we need to keep these things into consideration. So here's this kind of summary slide. So the capital structure, so what? For you as an entry-level manager, for middle manager, here are kind of the effects on you. So depending on what the interest rates are in the economy, and depending on your organization's credit rating, credit ratings impact the interest rates. So the better your credit, it's just like your personal credit score, right? The higher your credit score, the lower interest rates banks are willing to give you because you're deemed as a more reliable consumer than someone with a low credit score. So depending on what the prevailing interest rates are, debt financing may or may not be an option for a capital purchase. So when you're thinking of in your department, I want to expand my space in order to accommodate a new provider, a new physician provider, a new mid-level, whatever, or I want to buy a new surgical robot to expand the number of surgeries that I can provide. The request to you seems simple. I need $1.5 million. I need, $900,000 for whatever renovation. But at the organization level, they have to understand, well, what are the interest rates and what kind of effect is that going to have from a capital structure standpoint, looking at how interest expense is calculated, how net profit would be calculated, all of the bottom line effects are typically things that middle managers don't think about when they think about, oh, I just need money to renovate, I just need money to buy this new piece of equipment. There are domino effects throughout the organization when you take on capital expenditures. The second thing is, and it's very similar to the first one, depending on the financial performance of your organization at the aggregate level, equity financing may or may not be an option. So going back to, you want to do a renovation, you want to buy a surgical robot, you want to buy whatever piece of new fancy equipment. If your organization does not have a track record of having financial profits year over year, you may not have the equity within the organization to make those purchases. So why does your capital request keep getting denied? It may not be for any good reason other than, financially the organization cannot support that request because of the lack of equity within the organization. So again, I think this week really forces us to think outside of our department, forces us to think at the organization at an aggregate level, which is very difficult to do if you've not had the privilege of looking at your department in the context of all of the departments within a large organization. But I think this gives you some appreciation for that. And then the third bullet point there, depending on how a capital purchase is financed, it's going to, like I said, the domino effect. It's going to affect your taxable income. It affects the amount of taxes paid by an organization. It affects the entire organization. So when you ask for the $900,000 or the $500,000, whatever your organization considers as a capital request threshold, it's not necessarily just about your request. It's your request in the midst of all the other requests. It's your request in the midst of all of the financial performance of years past. It's your capital request in the context of the prevailing interest rate. So it's bigger than you, which is something that I think it's really good for department managers to have that understanding. We can think so at a micro level, at a small scale, and really a lot of these capital decisions are made on a larger scale, which affects many more departments. And then if you think about capital structure decisions as a whole, all of these decisions, so let's say your CFO or your finance director approves your renovation budget for $900,000. They approve your surgical robot for $1.5 million. Those decisions then will have an impact on the credit ratings, which it's a vicious cycle, which is what that little picture is. So your credit ratings are going to affect your interest rates. Your interest rates are going to affect your interest expense costs, which is going to affect your taxable income. And so, again, just be able to look at not just your requests in the microcosm of your department, but be able to take a step back and look at the fact that capital justifications or capital expenditures have an overarching effect throughout the entire organization. The decisions ripple on multiple levels in multiple ways. So I hope that helps. It certainly helped me when I was able to take a step back and look at decisions from a macro level. I could better understand why either my request was denied or why I was being asked to modify my request, or perhaps my request was being postponed, or I was being asked to look at other ways that the resources could be shared so that one person wouldn't have to incur, let's say if I was buying a surgical robot, maybe that's not the best example, but if I had some piece of capital equipment, were there ways that I could share that resource with somebody who already had one, or maybe I could go in with another organization, another department rather, and purchase one together. So there are reasons why people ask you to go and evaluate things, evaluate other options, because a lot of these things, like I said, have that ripple effect. I would recommend is, can you build the Excel spreadsheet on your own? Because if you can, that's a really good test of whether you understand this concept. It's one thing to plug in numbers and get the output, but it's another thing entirely to be able to recreate it without looking at this Excel spreadsheet. So that's my challenge to you, is if you can recreate this balance sheet P&L for the various options and understand what's going on with all of the calculations, you're basically set for capital structure. Okay, great. So Jen's feeling much better. Steph's feeling better. Elisabeth, great. Jess, hopefully you're feeling okay too. And if not, you're welcome to schedule some office hours with me. So the last thing that I want to go over, and I want to be sensitive to your time because it is 6 after, I wanted to make sure that you did look at the capital justification resource that I posted. I posted it yesterday, I believe, but some of you may not have seen it because the other materials were available sooner than that. The 5 steps here are really important. And I want to make sure that you're comfortable with these 5 steps, because most likely your project number 4 for next week is really going to be based in capital justification. The capital justification is going to include, basically, it's almost like a cumulative knowledge test. It's to see if you can generate a capital justification based on information. I will give you lots of information. So number 1, gathering the quantitative argument. You've done this You've done this week over week for the last couple of weeks. It's things like your percent change. It's your trend analysis. It's looking at proportionality, looking at common size ratios and things like that. You're looking for patterns. So if you're good at looking at the percentage changes, really analyzing what's going on with the number, then you should be fine in identifying these patterns and trends within your financial data. So most likely what I'll be doing for next week's project is giving you a P&L statement, a multiple years worth of P&L statements, and asking you to find the pattern, to find the reason why you can justify a capital expense. So you're going to need to justify the purchase, and you're going to need to obtain quotes. Now this is going to be, I'm going to provide the quotes for you, but you have to make sure you understand that if you're doing this professionally in the real world, you need to look for quotes for functionally similar items. And you'll see examples that I provided in the resources. So like, you can't compare a 16 slice CT to a 64 slice CT. And I think I said that's like comparing a compact car to an SUV. It's not functionally similar. Functionally similar would be something like comparing a Dodge Durango to a Ford Explorer, maybe to an Outback. I'm not sure if a Subaru Outback has a seven seat capacity or not, but you get my point. You're looking at, vehicles with all-wheel drive, vehicles with a back hatch, things that are functionally similar. So if you're looking for an EKG, you're not looking to compare a 2-lead EKG to a 12-lead EKG. They would not be functionally similar. They're both EKGs, but functionally one is the standard and one is not. The third thing, this is where lots of people in the professional area get caught up, is you have to look at the total cost to operate a capital purchase. So if you have, let's say, a surgical robot, and the robot has disposable surgical instrument arms, you need to calculate what that cost would be, because the surgical instruments could run you a couple $100 per instrument, and you might need 5 or 6 over the course of one surgery. So you have to look at what we would call a consumable. A more simpler example perhaps would be like for printers. You have to look at the cost of the printer toner cartridge. Some toner cartridges are really expensive. Other ones are not as expensive. So depending on perhaps what type of printer you get, the toner cartridges might cost significantly different. So look at the consumables. You don't want to focus on things that are minimal or things that are not going to be significant in terms of cost. So I think I gave the example in the resources. You don't want to compare the cost of electricity to run a printer. That's probably not going to vary. Unless you have a printer that comes out that's like super, super efficient and it uses 1% of the energy of typical printers. Then yes, it becomes a significant expense item. So you want to use good judgment. And a lot of this cannot be prescriptive. All I can say is, in the real world, you have to use good judgment. And no class is going to be able to teach you all of the many millions of alternatives of what that good judgment looks like. But you have to kind of look at, how much does it cost? What's the impact? How frequently does it happen? All of these questions. If you can ask good questions, you can be a good financial manager. The fourth option is, for a lot of biomedical equipment, especially in healthcare, there are lease options. So you don't have to outright buy things, but you can lease them. There are oftentimes, depending on, some of my students work in clinics that are in a financially impoverished area, so that it might be judicious for them to look at refurbished medical equipment. So not buying something brand new, but perhaps something that's 2 or 3 years old, that it's not an obsolete product. It still functions very well, but whoever owned it the first time, they have the resources to keep buying new equipment every couple of years, and therefore you get, so quote unquote, the used, but it's been checked over, inspected, made sure it's been calibrated, etc. So it's like new, but used in a certain sense. So all of these options in a professional setting, you want to make sure you look at the various options. The lease versus buy would also impact the future value, present value type of calculation. So that may be something that comes up in your project for next week. And finally, when you have, you're going to have charts and graphs and tables and, all of these calculations explaining future value, present value, you need to bring it all together. So you can't just give me charts and graphs, but you have to talk me through. So narratives, you can see some of the narratives that were done in PowerPoint form that were in part of your course resources. So it's the explanation that walks the reader through what you're trying to, establish as your argument for why the capital purchase should be made. Okay? So a lot of that, you'll be given templates. Don't worry, it's not like you're going to be just told, do these 5 steps. You're going to be given the information. You're going to be given, all of the quotes and things like that that you would need in order to compare things. But a lot of this is a little bit more open than some of your previous projects. This simulates real life a little bit more, and this is why it comes in week 5. It's your last project, and hopefully it will give you good practice for when you would have to actually develop a capital justification in real life. Now, I'm not making you do a labor justification, but make sure you look at the labor. The labor one's a little bit more cut and dry, only because if you print out that form, the template that's available in the course resources. It's funny, I actually developed that form, and it's, I think, still being used at least at Lancaster General. That form, if you can go through kind of the thought process and develop, whether it's a PowerPoint presentation or a Word file, wherever you go, if you can walk your director through all of these ideas of, yes, I've checked productivity standards, I've checked, different scope of management responsibility, scope of control, span of control, all of these things. If I've walked through that exercise, you will have done a very thorough job in justifying your labor. So from a thought process standpoint, I thought that was a little bit more concrete, a little bit more cut and dry, although remember, every organization is going to have a different setup. They might have a different form. They might require different analyses, but whatever it is, that's kind of the template that's provided there is really a good basis for you, a good starting point for you to think through how you're going to justify adding more labor. Okay. So it's 8:15. I believe this is we started at about 7:15. So again, I apologize for starting late and having those technical difficulties. If you have any other questions, I can stay on for another couple minutes, but again, I would encourage you set up time with me during office hours. If you have any specific questions, make sure you go through the quiz questions and try the end of chapter problems, and check back to the end of chapter problems frequently. I'm sorry, the discussion forum, because I will post the answers to the end of chapter problems so you can look through your responses on Thursday.